Good afternoon, and thanks to all of you joining today through Zoom and YouTube for what promises to be an enlightening overview from companies who are winning in the Canadian cannabis industry. I'm Peter Graham, Head of Cannabis Investment Banking at Echelon Wealth Partners, a role I have been responsible for since we entered the sector in 2016. I would like to thank today's presenting companies, High Tide, Rubicon Organics, Decibel, and Organigram for joining us today. Although these companies are all leaders in the Canadian cannabis market, they share little in their area of focus as it relates to the industry. What they do share has been a sound strategy and operational excellence, which has resulted in outsized revenue growth, market share accumulation, and profitability, even in the face of extreme competition and certainly less capital than many of their peers. Although metrics have changed as the industry has matured, where we used to talk about multiples of square foot or funded capacity or even revenue, we now have a selection of companies who can talk credibly about EBITDA, profitability, and cash flow. Our challenge and theirs is that we need to talk louder than the noise coming from the rest of the industry. Our cannabis franchise likes to view ourselves as contrarian and feel that even in today's challenging macroeconomic environment and arguably more challenging cannabis market, it's a perfect time to highlight today's presenters, not just as great businesses and operators, but great investment opportunities. With that, I'll hand it over to Andrew Semple, Echelon's Cannabis Research Analyst and moderator for today's conference. Andrew, over to you.
Thank you very much, Peter, and welcome to everyone. I'm very pleased to be hosting our virtual conference today. Together, we'll explore what we believe are the select few companies that are winning in the Canadian cannabis market. We are thrilled to welcome High Tide, Rubicon Organics, Decibel, and Organigram as presenters, all of which are leaders in their respective categories. These companies have demonstrated multiple years of consistent revenue growth, positive adjusted EBITDA, and market share gains, driven by unique strategies that led to their success. The presenting companies are remarkable for delivering consistent, profitable growth in the face of a challenging market environment for the cannabis industry. I believe it is important that we understand why these unique strategies have worked in the challenging Canadian market, because it could prove to be the key to understanding winning strategies in all cannabis markets globally, including those market opportunities that are currently emerging in the US and Europe. A few quick housekeeping items before we get started. First, each presenter will have a 30-minute time slot, which will consist of a 15 to 20-minute presentation, followed by a 10 to 15-minute Q&A session. I will personally be monitoring all of the Q&A sessions. Audience members will have an opportunity to submit questions either through the Q&A feature of the Zoom webinar or else directly to myself over email. And with that, I'm happy to begin with our first presenter today. So I'm very pleased to be able to welcome Raj Grover, founder and CEO of High Tide. High Tide has built the nation's largest corporate-owned store network with 153 retail stores located across the country. The company has experienced spectacular growth, with revenues now closing in on $500 million annualized, the highest run rate cannabis sales in Canada's cannabis industry. The growth has largely been driven by the company's unique discount club model, which has seen his market share increase more than twofold, approaching 10% of share of all retail sales outside of Canada. With that, I'm happy to turn the presentation over to Raj to tell us more about High Tide and the remarkable success you've been having to date. Raj, please go ahead.
Thank you so much for that awesome intro, Peter and Andrew. Appreciate the opportunity to present to everyone. Good afternoon, everyone. My name is Raj Grover, and I'm the founder, president, and CEO of High Tide. Most of you are probably very familiar with the High Tide story, but for our new friends joining us today, I'll start by providing a brief overview of our company, including our latest quarterly results that we just reported a few days ago. And then we can open it up to Q&A, and I'll be very happy to answer all your questions. High Tide operates in three main business segments, THC, CBD, and consumption accessories. High Tide is a retail-focused cannabis company with global operations. We have a very uniquely diversified cannabis ecosystem, which includes our flagship brand, Canna Cabana. So we have 153 locations in Canada today, operating across 5 Canadian provinces. We are the largest non-franchise cannabis retail chain in Canada, operating in Ontario, Manitoba, Saskatchewan, Alberta, and British Columbia. We also have Cabana Club as one of the largest, in fact, the largest loyalty program in Canada that includes 1,040,000 members of the Cabana Club. I believe that's about 14 or 15% of the marijuana smoking population outside the province of Quebec. We also recently launched the first of its kind in November of 2022. We launched the first of its kind paid membership program in cannabis, which is called Cabana Elite. And we've already signed 13,500 elite members, which are paying us a subscription fee of $30 a year for the first year. And that'll go to $60 a year from their second year to continue enjoying the premium benefits that we are offering to our Cabana Club members. We also own and operate 3 of the top tier international CBD brands, 2 in the US, 1 in the UK. New Leaf Naturals and Fab CBD are based out of the US, and Bless CBD is a top selling CBD brand in the United Kingdom. All of the CBD brands are direct to consumer online businesses, so they're asset light businesses, with the exception of New Leaf, which is also a CGMP certified facility to manufacture CBD products. And then we go to our accessories business. High Tide also owns and operates 3 of the top 5 consumption accessory platforms in the world through Grass City, Smoke Cartel, and Daily High Club. These are some of the most searched online platforms for cannabis accessories, consumption accessories on the planet, which we intend to use very wisely when federal legalization takes place in the US and in the states that are going to be allowing online cannabis sales. So as you can see, we have been reporting accelerating revenue and EBITDA numbers practically right since our inception. In just 4 short years, we've gone from roughly $8.5 million of annual sales to almost $500 million in annual sales today, as we just reported $118.1 million quarter, which was also our 3rd consecutive quarter of record revenue and record adjusted EBITDA. We also reported adjusted EBITDA of $6.6 million as our Q2 numbers that just came out on March 15th. Oh, sorry, that just came out on June 15th, excuse me. And this was also 174% of an increase in adjusted EBITDA year over year and 20% sequentially, which is, as you all know, an extreme rarity in Canadian cannabis or amongst Canadian cannabis retailers. Our average same-store sales continue to lead the country. We are now up on our last reported quarter. Our daily average same-store sales were up 5% quarter over quarter, and they were up 30% year over year. And since we launched our innovative discount club model about 1.5 years ago, or almost 2 years ago now, we are up over 100% in our same-store sales trajectory, which is again an anomaly in Canadian cannabis. So here you can see we have 153 locations in the country. Alberta is our largest market with 77 bricks and mortar locations. We have approximately 30 stores in Calgary, and the rest of the stores are all over the province of Alberta. Ontario is our 2nd largest market by brick and mortar footprint, but our largest market by revenue, where we have 49 stores in that market. Our long-term goal is to get to 250 stores in Canada. So we have a ton of growth still ahead of us. We are taking a bit of a pause on our aggressive growth strategy just to ensure that, in these very trying times in the capital markets, where all cannabis companies are feeling capital constraints, we can start generating free cash flow ahead of our peers. and become self-reliant, so we are not overly reliant on cannabis capital markets. And the good news is we are practically there, which I'm happy to share later on in the presentation or through the Q&A format. Our stores are also a very differentiated retail experience, as they're very open and have a very retail-friendly layout. Cannabis customers, when they walk in our stores, or our club members, they get really excited because they can see all of the cannabis products displayed wall to wall. Whether it's accessories, whether it's CBD products, whether it's THC products, you can see the actual product. Now, again, we are restricted to give those products and let them hold those products in their hands, but at least it's a very open and inviting retail experience, similar to other industries, very different or opposite from the rest of the industry on how they've been doing things in Canada and the US, where they simply have, large stores with 2-3 monitors, and you look and stare at the monitors and you order your product at the counter. That is not our model. Our members love the way we serve them, and that is a big reason of our success. We also carry some of the widest and the largest selection of cannabis, THC, and consumption accessory products in our stores. We carry up to 1,000 SKUs in our stores, which is not typical of a Canadian cannabis retail business. Typically, you see 300 to 500 SKUs. Maximum I've seen is 650 SKUs in one of our competitors. So we definitely lead the country on that metric of selection as well. One more thing I can quickly add, just to give you all a bit of an idea on how we look at brick and mortar stores. So we are very focused on cost control, et cetera, and we've been constantly trying to bring down what it cost us to build our stores. So currently we are spending, for a typical store that is 1,500 square feet, that is kind of the sweet spot for us for a Canna Cabana location. We spend about $300,000 on these stores as a CapEx, which is still very, very minimal when compared to our LP friends who have to shell out a lot more dollars to build out those facilities. But that is not the case with retailers. And I did want to point that out to everyone. So on this slide, you can see our innovative discount club model that we launched in October of 2021. I think this was our most important strategic decision that we've taken in High Tide, and it's paying dividends today. Our discount club model offers unbeatable prices, unbeatable selection, and has been able to quickly accumulate 1,040,000 Cabana Club members, which is a massive amount of customer loyalty that we've garnered, and this loyalty base continues to grow. It's also exceeded my expectations. We were expecting to be close to 750,000 members, which would still by far be the largest brick and mortar loyalty program in the country. But we've already exceeded 1 million members, and it continues to grow. So very exciting news for our business there. We've also ventured into white label products through our Cabana Cannabis co-brands, which I can walk you through on another slide. But we are really trying to create that Apple style closed ecosystem where, once you're a customer, you are going to shop with us for consumption accessories, but because you just can't find those deals elsewhere. And the same with cannabis products, the same with CBD products. And we are serving our customers through some very exciting ways and technologies, which again, I'll share in some other slides. So as you can see, very proud of this accomplishment. We have exceeded our own expectations in terms of same-store sales growth. Our same-store sales are up a massive over 100% since the launch of the discount club model, while the national same-store sales average, or all sales excluding Quebec, total sales, not just same-store sales, were only up 15%. So this paints a really good picture on how quickly our concept is rising and how quickly we are accumulating cannabis customers across the country. This is a very important slide and a very exciting slide. You can see that Canna Cabana is now approaching almost 10% of the total retail market in Canada. And we have done this with just 4.5% of the total brick and mortar store count. So total Canna Cabana locations, which are 153 stores, amount to 4.5% of total brick and mortar store count, excluding the province of Quebec. And we are already hitting close to 10% market share, retail market share in the country, which is an aspirational number for many of our peers. But for us, 15% is very much within reach. We don't think that it's going to take us too long in the future to hit that milestone, and it may even go higher than that. But I'm a firm believer of under promising and over delivering, and we think we can definitely reach a 15% market share in Canada. Our stores in Ontario, which is our largest market by revenue, is doing 3.5 times the revenue of our provincial peers in that province. And in Alberta, where we have the largest brick and mortar store count, which is 77 stores, we are doing over 2 times the revenue than our peers in that province. And then it's a similar story in Manitoba and Saskatchewan as well, including British Columbia, where we just started opening stores in June of 2022, but it continues to be accelerating sales, accelerating revenue every single week over week. So we rolled out the first of its kind paid membership program in cannabis, which was always the plan when we launched our innovative discount club model. And now we already have 13,500 members subscribed to this premium offering, and this number continues to grow. This number was 9,500 when we reported our Q1 results, and it's gone up 42% since. And we don't see this slowing down. We continue to sign more and more elite members because we continue to offer them exclusive benefits such as elite flash sales, limited edition accessories, limited and exclusive elite branded products. And it's just for $2.50 a month currently. So it's very, very affordable. We are taking care of our customers in these very high inflationary times, so they can try and test this program, and we know they will love it. And from the second year onwards, we can collect $60 a year from our members going forward. This is also a very high margin stream for High Tide, for Canna Cabana. This is north of 70 to 75% gross margins that we yield out of this program. So it remains to be a very exciting margin enhancing opportunity for us. Thank you. So in June of 2022, we started, because we have the size and scale in the country, we have 153 locations across 5 Canadian provinces. And now it makes perfect sense to start introducing our own white label brands. Although I would like to point out challenges still exist because you can't transfer stock between provinces. Alberta still does not allow white label, although we are in conversations with the provincial government here that just like all other normal industries, it should be allowed. It is under consideration, and we believe that it could be the case by the end of this year, which will provide a great margin enhancing opportunity for us. And it'll provide a very good opportunity for all operators in the province as we be able to differentiate our products even more. But currently, we have 13 white label SKUs in the market, which range from infused pre-rolls, ounce bags, vape cartridges, edibles. We have all kinds of products, including a new leaf natural products that we've introduced in the prairie provinces of Manitoba and Saskatchewan, as well as in the province of Ontario. They continue to do very well, and we have more offerings planned for the rest of this year and throughout next year and a few years beyond that, to get to 25% of all of our in-store offerings reflect white label products, which is our Cabana Cannabis Co. and other house branded products. White label products also offer us an opportunity to increase our margin by roughly 5%, an extra additional 5% margin, which goes a long way in the Canadian cannabis retail landscape. So this is another very exciting piece of technology that we acquired through a purchase of a retail store in Ottawa, Ontario. We already have this technology equipped in 120 of our locations. We are going to install this in each and every one of our stores, but we have a goal to get to free cash flow positive by the end of this calendar year, which we are very excited about. So we've taken it a bit more slower because this is part of our sustaining CapEx. So we are just pacing it out, but this technology is super exciting. Our customers are very excited about it. Our staff is very excited about it. This technology is catalyst to expected faster transaction times, increase average basket sizes, lower overhead and labor costs. As you know, the labor line is one of the most expensive lines to manage in North America and Europe, and this technology greatly helps with that. The exciting part is that we also have a lot of inbound leads coming into us from the US market for dispensaries that are looking to install this technology. We are first looking to have this installed across our network because we are still working on acquiring more hardware, and then we are still working on acquiring all the data that we can get so we can properly, accurately price this offering in the United States and beyond. But this remains another huge margin enhancing opportunity for us, and also a cost controlling opportunity for us. Similar to our SG&A expenses, I'd like to point out, our SG&A has come down to roughly 5% of revenue, down from 6% of revenue quarter over quarter, and down from 7% of revenue a year ago. So, we are very focused on cost controls, and together with all of these elements of Elite, White Label, and Fast Tender, we believe that we can continue doing a better job in managing our margins and reducing our costs. Andrew, I hope I've timed this well. We have 10 minutes left for Q&A, so hope that works.
Done beautifully, Raj, and looking forward to our chat now. So thank you for the presentation. I think I want to start off with maybe a high-level question on this discount club strategy, because there's a slide just earlier where we saw the performance of High Tide's market share before discount club was implemented and afterwards, and obviously market share has just taken off, and it's been a very successful strategy for you. Same store sales growth, I think, peaked at just over 50% year over year. Even in the most recent quarters, 30% year over year. So those are pretty incredible growth rates. Why, if the model's been so successful, why do you think more retailers haven't tried to replicate it? Why is there a moat around this model, or why do or why haven't we seen more companies adapt to this model? Why is that in your view?
Thanks for this great question, Andrew. Love to answer that. So, we have always catered to our own ecosystem and our own strengths. And I've said this from the very beginning. And every time I speak to investors, it's the same response, that we've had a very diversified, uniquely diversified cannabis ecosystem, where we also have our international CBD brands that we sell online, and also our accessories business, which we are able to mass produce overseas and then sell into markets, not only just in Canada, but beyond as well. So when we have our discount club model, it's feeding off all of these elements. We've been retailers since 2009. We started with Smoker's Corner, which was accessory shops. We had 19 accessory shops at their peak that we converted into cannabis retail, but we really leveraged our accessories model even in those accessory shops. So we knew coming into the business, our strength was accessories. So what we did, Andrew, is we cut off wholesale in Canada strategically just to launch this model properly. And we started discounting accessories to up to 80% off, because we manufacture all of these accessories. How many independents or small regional chains or large players you can think of that do this? None. None that I can think of or say that they are doing it in Canada or even in the United States. So this is a unique edge that we've had in High Tide that we've leveraged very, very well. Same thing with CBD products. When you have high margin products that are yielding 50, 70, 80% gross margins, and you're fighting for, four-wall margins in Canada here, which are now climbed nicely to 20%, but still way below our MSO friends in the United States, you must think creatively on where you can get that additional margin to, continue getting this market share. And hence our market share is climbing, because we were not desperate to keep our prices where we needed to keep them and still yield good results and still have accelerating EBITDA, still have accelerating revenue dollars. And basically, we are standing at that free cash flow break-even level today. And this wouldn't have happened if all of these elements did not come together. So simple answer is no one else has this ecosystem. This is very, very proprietary to High Tide. We already had 245,000 members of the Cabana Club when we launched the discount club model. And because we leveraged that membership base, today we are over 1 million members, and I can't think of anybody else with the Fire and Flower saga unfolding. They had close to 500,000 members, and I don't see anybody else that's even remotely close to our numbers now. So it's a very, very unique proposition to High Tide.
That's great and very helpful. And also just a reminder to the audience, if you do have questions, feel free to submit them through the Q&A. One more here, and I'll see if there are any audience questions in that chat. It's obviously been a very tough market in Canada. It's been evidence that it's been a competitive market for Canadian cannabis retailers. And yet, here you are reporting your 13th consecutive quarter of positive adjusted EBITDA. Just what did you learn from competing in Canada that you think will be relevant to international market opportunities as those emerge? What's the key kind of takeaways from your strategy as you look overseas potentially?
So Andrew, I always say this, Canada has made us battle hardened, right? Like I was not expecting that we would be talking about 20% four-wall gross margins, but on the opposite end of it, still have 13 consecutive quarters of positive adjusted EBITDA, right? So we have always been a very operationally focused company, right since our inception, right since Smokers Corner. We've launched many businesses along the way very successfully. And we've always, despite the noise in the capital markets, and especially the cannabis capital markets, we've remained focused, head down focused on our business, and we continue to yield these results. I can't wait to get to the US and get to other international markets where our peers there are enjoying, north of 50% gross margins. Add our diversified cannabis ecosystem, companies are going to find it quite tough to compete with High Tide. This is a prediction I'm willing to make. This is something that I've said publicly that, our long-term ambition is to be a top 5 multi-state operator in the United States. And if we can do this in Canada by being very focused on our operations, by understanding our business really well on how all of these pieces fit together, we feel we can do exactly the same in US and beyond.
Great. And question from the audience from the Q&A function. It asks whether you foresee liquidations or challenges with some of the LPs in Canada, but I'd actually even broaden that to include both the LPs and other retailers, and whether this offers High Tide opportunities to capitalize on the challenging environment out there, maybe through gaining power over your suppliers or potentially being able to execute on M&A with other struggling retailers. What opportunities do you see in the challenging market environment?
Yeah, absolutely. So we have been in consolidation mode for quite some time now. It's not a new thing, Andrew, as you know, but consolidation is picking up steam. As you know, even some of the most well-capitalized operators that you could call them, with having the backing of some groups that are seriously capitalized, even they couldn't hold on to their cannabis operations because it all again goes back to, do you understand your business well? Are you operationally a very, very sound business? And unfortunately, a lot of the groups that have got into cannabis, some were just, a lot of backing from the capital markets and knew how to raise capital, or just a dream about opening a cannabis store. Unfortunately for the independents, look, I was an independent, so I feel their pain, but there has to be a concrete, solid business plan. There needs to be a contingency plan for the what ifs that we are experiencing in cannabis. But fortunately for High Tide, Andrew, it opens up a lot of opportunities for us on a weekly basis, on a monthly basis. Sometimes I get offered, here are keys, Raj, could you buy our store? And you find out they're doing $1,000 a day or $1,500 a day. My threshold to look into purchasing a store starts at $5,000 a day or a $1.8 million store. And unfortunately, I have to tell them no. And then they say, we're just willing to give you the keys because we're losing our shirt. And I'm like, I still can't take it because then I'm acquiring a lease liability from you, which I have no interest in, right? So you're going to see a lot more bloodshed than what we've seen so far. Alberta's had negative store growth for 6 or 7 consecutive months now. Ontario has had crested store growth. It's not moving anywhere, despite now Mississauga coming in. It's very much flatlined. So this presents, and I believe because of this 5-year anniversary of legalization coming up, many of these leases were signed 5 years ago. And now folks have to decide, what are we going to do? Are we going to mortgage another, get another mortgage on our house? Are we going to refi this situation? Are we going to try it out for another year or two? Or just put our hands up and get into something different? And that is starting to happen left, right, and center, which presents a very, very good opportunity for High Tide. We're going to remain very disciplined on that, Andrew. We're not going to jump on every opportunity, but we're absolutely very seriously evaluating everything we're doing.
And just very quickly, because we only got 30 seconds here, what kind of valuation multiples are you seeing in maybe a more distressed and challenged environment?
So look, we were the deconsolidators in space. We have been for a very long time. We have 153 stores in the country, out of which roughly half and half were acquired and half were built. And we did some of the most accretive acquisitions in the Canadian cannabis industry at averaging the EBITDA multiples at 3.5 times. And now we are looking at things for 2.5 times. And if it's not absolutely interesting, we would still not be pressing the trigger there, right? And sometimes it's going even lower, like we bought the Choom assets in bankruptcy proceedings or CCAA proceedings last year, and we paid a 3.5 or 3.6 multiple of EBITDA. And those stores have tripled for us in revenue. In some cases, have quadrupled for us. So we are finding these very good deals out there, and we are not even paying what we were paying previously for these businesses.
That's great. Well, Raj, thank you very much for joining us today. Always a pleasure to catch up, and thank you for your presentation. It sounds like business is going very well for the company, and we look forward to continuing to follow along.
Appreciate the opportunity, Andrew. Thank you so much for having me.
Great. Thank you, Raj. So we'll move on to our next presenter here, which is Margaret Brody, Interim CEO and CFO of Rubicon Organics. As a licensed producer of cannabis, Rubicon has taken a very unique approach to the cannabis market by prioritizing premium quality, organically grown BC bud. It has done an excellent job communicating its value proposition to consumers, with its products commanding a premium price points, even relative to other premium brands. And it regularly sells out of all of its current production. Last quarter showed sales up more than 70% year over year, a pace that far exceeded industry growth, a surprising statistic given that most other operators have pointed to value price products taking share. So with that, I'll turn the call over to Margaret to tell us more about Rubicon, how you've managed to build a premium brand in a market where many others have struggled to do so. Please go ahead.
Rubicon Organics is the industry leader in premium organic cannabis. My name is Margaret Brody. I'm the interim CEO and CFO of the company. I've been with Rubicon since its inception, which is 8 years, actually. My background is I was a competitive athlete and a rower with 5 a.m. mornings for 8 years. I'm a CPA with KPMG for almost 10 years, where I spent over 6 years of that time after I got qualified in London, England, working on global accounts. I then moved into the mining sector in Canada for 5 years and on to cannabis in 2015, probably pretty early days compared to a lot, when I saw the opportunity and was really passionate about being able to build a new business and a new industry in Canada. What you can see here is our standard disclaimer and forward-looking statements, et cetera, so please read with detail. Rubicon Organics is a leader in the Canadian cannabis sector with our premium and super premium brands. We have been established as a great BC cannabis company, and we are very proud to be taking our famous BC weed to the world. We have delivered 4 consecutive quarters of adjusted EBITDA profitability and 3 consecutive quarters of positive operating cash flow. We did this all through our 3 brands: Simply Bare Organic, our super premium flower first products; 1964 Supply Co., our premium flower first cannabis products; and Wildflower, our topical and wellness focused brand, where we deliver consistent, high quality, organic certified products that are recognized and winning with consumers. Rubicon has executed on building 2 of the strongest premium flower brands in Canada in arguably the hardest segment, premium flower, delivered through the quality of our operations and our people. From a BC weed story perspective, for those of you who are unaware, there are 4 places that have true cannabis heritage: Jamaica for the culture and Bob Marley, California, its cultivation, its influence, and its trends; the Netherlands for its open coffee shops; and BC, where the draft dodgers came from the past and established the lore of BC weed. Any weed consumer in the world knows the power and strength of BC weed and its legacy from the small communities and groups that established medical marijuana in Canada. BC bud is to Canada what California weed is to the US. And we as Rubicon embrace and respect the legacy cannabis culture and market. We have a team mixed from those who grew up in the traditional professions to those from the legacy market who are getting their first mortgage eligibility with us and tax-paying jobs. Our team with legacy roots are always watching current trends, West Coast legacy market trends, and they really know what great weed is, and we stand for it. I am proud that our interdisciplinary team works together to help consumers understand what premium weed is and should look like. And it's not just what the package said, but the quality of what is inside drives the brand promise. Now, a few themes you're going to hear from me today. Rubicon is leading in premium and super premium brands, and they are recognized and winning based on our execution, proprietary organic methodology, and quality of what we do. These brands are becoming some of the very few long-standing premium brands on shelf here in Canada, and there is considerable room to use the competitive advantage of our brand value to expand these strong brands. We play in the profitable premium segment where the 80-20 rule applies. It may be 80% of the market sells mainstream or value products, but most of the profitability sits in the premium market, being around 20% of the market. And all our products deliver gross margin, and we have no loss leaders. Our execution has been key, and we have used our second mover advantage to watch the mistakes of others and not get over our skis on costs. We focus on two things: quality and the consumer who cares about it, and our people and our team who I'm proud to work with every day. They have passion for the quality and delivery to our customers. The Canadian market is growing considerably, and within the premium category is actually growing even faster. The opportunity for growth still exists in cannabis, especially for companies like Rubicon with a strong, established brand presence that we can now build upon. In addition, in this next phase of the Canadian market, weak operators are falling out of the market or being consolidated at bargain prices. And our last point is our brands are built, recommended, and we are ready for growth. The table is set for us to lever off of to build a larger business. We have laid the foundation with our brands, our execution, to build the BC bud leader in Canada, and we aspire to be the Lululemon of weed. A few of our fundamentals are here. We have over 2% market share. Most recently, I just saw a stat at 2.3%. More meaningfully, we have over 5% of the premium market, which, as I said before, was the most profitable and sticky on price. Our facility is located in Delta, BC, and produces consistent, premium quality, organic certified products due to our proprietary methodologies and strong operational execution. Our brands are located in the key provinces of Quebec, Ontario, Alberta, and our home in BC, and we cover 97% of the addressable Canadian market. We are also tightly held with 43% insider ownership and consistent insider buying. This is an exciting slide for me to present. In the early part of 23, Brightfield studied bud trenders across Canada, and we were very proud to see in those results that 2 of our brands were recommended in the top 3. Our super premium Simply Bare Organic and our premium 1964 Supply Co. held the 2 of the top 3 spots. This is a discerning and very influential group when all products are behind glass, and a conversation with bud tenders is required to purchase a product in Canadian stores. Furthermore, the 1964 brand was only launched nationally in 22, and in April this year reached the #1 ranked premium brand in the country. The trajectory of our brands and their good reputation means we're ready for further growth. Not just flower, but we have other categories as well, and our Wildflower brand has become Canada's favorite topical product. We wholly own the brand and is the #1 topical in Canada with over 17% market share. The product is sitting in that comfortable premium entry point product for those not ready to ingest but looking for the benefits of CBD wellness. Wildflower has given Rubicon a strong platform to grow the brand and new product formats and categories. So Rubicon was not the first LP to come to market, but we have learned a lot from watching others and understand that operational execution and processes are key to success. We aim at being the leading premium cannabis company in Canada through our competitive advantages. We cultivate organically certified living soil in living soil, which provides a more flavorful and terpene-rich flower which consumers love. We drop new strains regularly and are monitoring legacy market trends to deliver new news to our brands, very similar to the cookie strategy in the US. We have brand awareness and foundation set for expansion with more profitable product formats. Given our capacity constraint, we can focus on selling our most profitable products from our Delta facility. We also, as I mentioned, have support of the cannabis community with bud tenders recommending us in 2 of their top 3s. We also have won a series of awards, and just 2 of them are shown here. We recently won BC's AR Cannabis Cup in 23, where our Simply Bare Organic oil tanker won Best Gas. to the Kind Awards in December 22, where 1964 won, and our comatose strain won Indica of the Year, very high honor. I'm also very proud how quickly 1964 has reached #1 in Canada and as a premium brand. And I believe that was built off the brand strength that we built with Simply Bare. It is an example of what we mean by we say the bud tender matters in Canada. When Simply Bare launched a secondary brand, bud tenders knew to trust the Simply Bare company quality. Our success has been driven by exceptional products, customer-centric approach, and strong operational execution. So what is our magic sauce? Our products benefit from the power of the sun with the protection of an indoor greenhouse environment. We use our organic certified proprietary methods with our BC living soil, together with craft processes to bring a hand-trimmed, hand-packaged product delivered with care to our customers. And that caring shows up in what the bud tender and consumer feel when they receive our product. This is about operational process and people to build consistency. Many of you would have seen the ups and downs in brands in cannabis industry, reminding you that in Canada, you cannot see through the product when it's purchased. The early days, early LPs built nice looking brands, but had terrible weed inside, meaning the consumer didn't get their first moment of truth. Instead, they were disappointed and left the brand. What we are building is consistency. When you pick up a Rubicon product, you know it's going to be great. We believe that great product quality is the foundation for building strong brands with longevity in Canada. Rubicon has built a good, better, best strategy for our brands. Even better, every product we sell is profitable and targets a different group. So I've talked about the buzz around our brands, but here's what they do. Simply Bare Organic is our super premium and organic certified, flavor-focused, unique genetics with regular new drops targeting the knowledgeable and discerning cannabis connoisseur. 1964 is focused on recruiting legacy consumers by offering classic organic cultivars. Now we cultivate for Simply Bare in 1964, but we have an outlet for our product that does not live up to the quality, and that goes into Homestead. This product is only available when it comes up and has become a recruiter into our other brands for the budget-conscious consumer who appreciates quality. As you also saw, we have built an own premium and best-selling topical nationally with our Wildflower brand, and you will see us extend our products across this brand, beginning to build the wellness category in Canada. We believe this market has huge potential for growth. And since we currently sell all of our product and are capacity constrained, I'm going to speak more to our growth opportunities later. About our infrastructure to deliver what we do, we started with the right size facility. We didn't overbuild. We have 125,000 square feet with annual production capacity around 11,000 kilos on a 100% owned 20-acre property in Delta, British Columbia, which is an agricultural district, which means we have easy access to agricultural labor forces. It's also 20 minutes from the Vancouver airport. Our facility is organically certified, which means our plants and product flavors benefit from living soil and a larger expression of terpenes or flavors in our flower. We have a premium hang dry and cure process to make sure that the great flower we cultivate is processed with care and we deliver a consistent premium quality flower. The benefit of this facility is that we deliver indoor quality with greenhouse costs. And the proof of all of this is in our inventory loss numbers. You can see right in our financial statements, we have industry low inventory loss rates. I want to take a moment to say what I pound into our people every day, which is our 4 priorities for driving profitability in 23. The first is we are in endless pursuit of optimizing yield and improving our quality. That will be in the top left-hand corner of this page forever in our lifetime. We believe we can always get better. Secondly, it's to maximize the Canadian premium opportunity. For every gram we have, we want to look at how do we maximize the gross profit associated with that. In addition, we've launched products that do not take capacity from our facility, such as our recent launch of 1964 edibles. We're also driving efficiency in processes and systems and institutionalizing for growth, such as onboarding an ERP system. And then we focus on our people. And I've talked about quality, but the other secret sauce is people. Because we are in a premium business, The love for what we do is critical, and every member of the team needs to care about the product getting properly into customers' hands. Here's a summary of our financial journey for the P&L and cash flow. Against a backdrop of other Canadian companies, we have achieved consistent positive trajectory of revenue growth, profitability, and positive cash flow. And in 2022, for the first time, delivered both positive operating cash flow and adjusted EBITDA profitability. Despite the impacts of dry January and seasonally down Q1, we continued our profitability trend in 23 thus far. And I would note our adjusted EBITDA calculation is very clean. It only adds back the fair values of our cannabis plants and share-based payment, not inventory losses, R&D, or other types of costs. In Canada, we are one of a handful of companies that have demonstrated consistent growth without costs out of control. And we watch our costs very carefully. We monitor budget to actual reviews with each department every month to make sure the business has limited surprises. We are the right size to deliver continued profitability, cash flow, especially as we continue to see industry changes. In the last 12 months, we have seen consistent 12-month rolling growth and a 68% increase in revenue and over 300% increase in our gross profit before those non-cash fair value adjustments. You will see shortly the growth in the premium market, and we are outpacing that with our revenue. With our most recent Q1 results, you can see our results dip down with the seasonal impacts of dry January, but we have maintained profitability and set ourselves up to deliver in 23. You can see here, as with others in the sector, we incurred significant startup costs, but given the size of our operation, you can now see the benefit of our work, and we expect to be more pronounced going forward, finding the equilibrium between making sure our balance sheet stays strong and delivering profitability. And I believe there will be significant growth opportunities in the next year and a half, and we are readying for those moments. I would encourage you to review our financial statements. And within that, you can see the rigor of our work. We are operators who review our costs carefully. As I said, we move forward with data-based decisions, and we believe that building this industry is brick by brick, with the future Lululemon of weed being built today. It is built by operators who assess opportunities, take calculated risks, and consistently deliver. The brown foundations have been laid, which means that we can capitalize on this growth. So why do we believe that we will continue to grow our business? The market is growing. This chart is the 3-month average growth looking back, and we expect that the legal market, which is $4.5 billion in 22, is going to grow 10 to 15% this year, and higher rates within premium. The market will be over $5 billion by the end of this year. More importantly for Rubicon, the current trends and data indicate over the next 3 years, the premium market will grow over $300 million. Now, I'm sure you are all aware of the negative headlines for many cannabis companies in Canada who are struggling to operate in the current environment. And as I've said, the legal cannabis industry is $4.5 billion in 22, growing. The illicit market still holds an estimated 40 to 50% of the total market. And the general view is that pricing in the current cannabis market has hit its floor, and we've started to see the value players take back price. But there still remains an excess of low quality production and low quality uncompetitive capacity in the market. This leaves many Canadian cannabis companies and LPs in a tough spot. A large portion of LPs have failed to execute on their business plan, are over-levered themselves with too high a fixed cost base. In addition, over an estimated 70% of licensed producers have unpaid excise tax, and the CRA is beginning to come calling for that excise remittance. We expect there will continue to be CCAAs and bankruptcies in the sector through 23. So for Rubicon, the dichotomy of a growing market offset by companies and market share failing means opportunity. Not only will there be more shelf space to win, with our brand recognition, execution, and balance sheet, we are in a position to be choosy on how we move forward, and we will not let that growth opportunity pass us by. So how do we grow our business with a single capacity constrained asset? Firstly, with organic growth. We are maximizing our yield and quality from the Delta facility with installation of tables and the remaining 50% of the facility that lacks them. This will increase air circulation in space, meaning better health, plant quality, terpene levels. We will target the most profitable products to sell for the highest return on our fixed cost base. And we're also looking to grow the overall premium segment, where we only currently sell about a third of our product is Simply Bare Organic, our most profitable strains, and we expect to increase that in the coming years. Secondly, we leverage the power of our premium brands. In order to do this, we are applying external capacity to our business through our manufacturing relationships, such as our newly launched live rosin edibles, 2 flavors launched and 3 more coming to stores near you next month, and extension opportunities for our Wildflower brand. But secondly, through targeted and trusted contract grow relations to fill the demand for our brands where appropriate, broadly an asset-light approach. This means we're taking advantage of knowledgeable cultivators who are not looking for the complexity of building sales and marketing teams, but just want to grow great weed. With over 1,000 LPs in Canada, we have a lot of choice, and solid cultivators do exist looking for an outlet like ours. Lastly, we will be opportunistic as and when the right opportunities arise for our business to grow. As you will see in our guidance, with cash flow positive year, we are in an opportunistic position, and we see a growing marketplace and demand for our loved brands, offset by assets in the marketplace getting cheaper by the day. I am very clear that I would prefer to bring into Rubicon a great operating business that is delivering at a fair price to grow our business strengths, or distressed asset that our team can make work for pennies on the dollar. This is a time for operators to take over the cannabis industry, not financiers. And as operators, we believe we are positioned to build a great BC weed company and taking BC bud to the world. Few companies in the sector are positioned financially, such as Rubicon Organics. With our premium market position, balance sheet, and positive trajectory, we expect to deliver continued growth in net revenue, resulting in an increase in gross profit and adjusted EBITDA for the full year 23. And one caveat I will mention is being opportunistic on our cash if there's the right opportunity. So what you can see here is Rubicon has delivered. We have a steady stream of milestones in hitting operating cash flow and adjusted EBITDA positive in 22, and having 1964 go from a standing start in 22 to the #1 premium brand in April of 23. You can see there's a lot more yet to go in terms of our plans as well. So who are the people building this Canadian premium cannabis company? Well, the women seem to be getting it done around here, and I'm proud to work with this exec team where 4 out of the 5 are women, and it is all about people. This is just a snapshot of Rubicon and our senior leadership team and the people and strength we have. In the spring, we announced our new proposed board members, and the onboarding process is underway. We have brought expertise and experience to our board of brand managers, manufacturers, government relations strategists, and governance experts. We plan to hold our AGM in September, where we expect our board observers will be successful in their nominations, and our comp committee is currently seeking third-party input for appropriate compensation for our board members and C-suite to stay in line with appropriate comparators. We like to do things right. The board has decided the CEO role will be determined once the new board is fully onboarded and has time to do the process right. And I have a high degree in confidence that the board is taking the right steps for Rubicon. For the time being, I will continue as interim CEO and CFO, and the existing leadership team continues with the strategy and is focused on the next milestones. So Rubicon has an extremely tight float, high alignment from our management and insiders, holding over 43% of the common shares. And you'll see that our insiders continue to support the company online from a steady stream of support. From an investment perspective, every CEO tells you their company is undervalued, and I'm not going to be any different because we are currently trading below 1x 22 revenue, delivering profitability in a quickly growing market. I believe with our tight flow, insider support, and profile, there is a compelling investment case given the foundation and growth that we have in our business. So here's a little bit of fun and a bit of a sneak peek before I take questions. You can see some of our 2023 drops. We've got Scott all under Simply Bare. Cleopatra flower is in market, but Scotty Biscotti and Jelly Breath have not yet launched. So it's always fun to see the beauty of the plants that we grow. To thumb up, I'd like to thank Andrew and Echelon for the invite, winners of Canadian Cannabis, confident we'll live up to that name and are living up to that name, and that the operating execution and our growth strategy has set the table for more success to come in the profitable premium market. So thank you for your time today.
Thank you very much, Margaret, and very well presented. Really appreciate that. So
course.
we'll hop into Q&A here because we're just a little tight on time. So
Sorry, apologies, I went long.
No worries at all. And reminder to the audience, you're welcome to ask a question in the Q&A function of the Zoom webinar. I'll kick things off here with the first question. And that's really on the difference from what we're hearing from, let's say, other licensed producers, both in Canada and the US, which are often talking to the surge in demand for value brands, and what we're actually seeing, play out in the data and play out in Rubicon's results, which is the premium market's actually holding up quite well. Consumers continue to look for premium products, and there is a role for ultra premium products to play in the market. So what do you think explains this kind of dichotomy, that we're seeing, the strong continued performance of premium products in markets? And what explains Rubicon's outperformance even relative to premium as a category overall?
Look, I think there's two big trends we've seen in premium. One is quality. You can't just say you're entering the premium market. A lot of people have tried to do that, and I won't name names, but we've seen it happen a lot. Every large LP, the largest of LPs, not every large LP, I should say, has suggested a premium strategy. You need to be focused on it, live it, and breathe it with every part of your business, and your product quality needs to actually be premium. That being said, the other big part of it is genetics and having new news with drops, very similar to the cookie strategy. We are constantly looking for new news, dropping new and interesting products that the market is looking for, and delivering them clearly and well.
Great. And then a second question for myself. Obviously, the Brightfield Award was quite notable of the top 3 brands to belong to Rubicon, and there's hundreds of brands in market, so quite the accomplishment.
Yeah, we were really pleased to see it. We did not know about that study. That it was obviously a third-party study.
Great. So that begs the question, especially in a market with restrictive advertising, how did you build a brand and build that awareness in Canada? And what was the strategy behind building a premium brand?
Well, I can't give it all away. Mel, our Chief Commercial Officer, would shoot me. But we have our own sales team that are focused on what we do. When we do something, we focus on doing it well. We are not trying to do everything. We're trying to do what we do well. One of the things that's been interesting coming out of that Brightfield study, I think we just launched our live rosin edibles, which are a slightly differentiated product in the market. Live rosin comes from a whole flower extraction, which gives a more full-bodied experience. And most people are using, cheap distillate into their gummies. So the experience is quite different. When we do something, we want to focus on how we can differentiate, speak to our consumer, and speak to the brand. And we're very focused on that.
Great. And we do have a question from the audience here. Yeah. And the question is with regards to your expectation for potential legislative reform, including on items such as excise tax, advertising restrictions, and the issues these have potentially posed. And maybe I'll even broaden that and say, what's your expectation on reform? And in the absence of reform, do you still think that you could grow to what we've seen in the past?
Great question. There will eventually be reform. I think it will take a minute for government to make that reform. I think the low-hanging fruit is some of the regulatory items. I do expect that there'll be a change in the edibles category initially, in terms of allowing more THC per unit. I think marketing and advertising is great, because what we actually need to get away from is this THC story, that's the only metric in Canadian cannabis. You don't walk into an alcohol store and say, what is the highest percentage of alcohol that I can get? And I'm sure Bina will speak to the same point in a bit. Look, we think that the full body what we'd like to do is speak to the characteristics of the individual items. And I think that that's because of the issues that have happened in market with THC testing, I believe that the government is actually open to that, understanding the effects where our Blue Dream that comes in at a 21% THC hits and feels more wonderful than a whole bunch of products that say they're 28% because of the full-bodied terpene-rich experience that you're getting out of it.
Great, and maybe we have time to sneak in one more, and this would be more of kind of a blue sky opportunity. Where do you think the premium market as a category goes from here? How large can we get? What would be your total addressable market opportunity? And as you continue to take share, what would you target as Rubicon's share of that premium market?
Well, I'd like to hold the same share we've got as with a growing market. That would be pretty nice. And that math would put us at a 100 million revenue target. Now I've got to get the biomass to do that. And then we are actively working on that, as I mentioned, in an asset light approach with great cultivators that are out there. Look, if the brands have the brand recognition and they continue to have quality in them, I think the sky's the limit in terms of where you can go. But we're going to do it with data, with one foot in front of the other, not getting over our skis, because I truly believe that the great future Canadian cannabis companies are in this group that are presenting today and will be the future large companies of Canada.
Great, very well said. Well, thank you very much, Margaret, for joining us today. Great job with the presentation, and we enjoyed having you.
Great, thank you very much, Andrew. Appreciate it.
All the best. With that, happy to move on to our next presenter. And I now have the pleasure of welcoming Stuart Boucher, CFO of Decibel Cannabis. Decibel had very early on built a reputation in premium dried flower with its Quest brand. It has proven to be very adaptable to market conditions, launching its value-oriented general emission brand product line and quickly becoming a leading supplier of extract and derivative product formats once Cannabis 2.0 product formats were legalized across the country. This includes leading market positions in vapes and infused pre-rolls today. Profitability was also a very early focus for the company, and with its most recent quarterly results, Decibel notched its 11th consecutive quarter of positive adjusted EBITDA. With that, I'd like to turn the call over to Stu for him to discuss Decibel and more about why the company has been so successful in such a challenging market. And with that, Stu, please go ahead.
So appreciate being here today. Just getting into who Decibel is. We're a leading cannabis company within the Canadian market. We pride ourselves on a few very specific things. So innovation, R&D, quality, consistency, many of those things that we believe over time build brand equity and consumer loyalty, which, we're in the early innings of. And we think that's the most important factor ultimately to building success within this marketplace. We think we've achieved early indications of that, and are very proud certainly to be one of the strong players within the Canadian marketplace who's now starting to take those brands into the international landscape. We've been able to do all of that in a profitable manner, as you mentioned, with certainly a tremendous amount of financial discipline. So getting into, Getting into Decibel at a glance, we have broad distribution across Canada, certainly some additional opportunity for distribution. So on the left-hand side, you can see all the green markets are where we are in today. And that's across two specific brands. So General Admission, which is kind of your core catering product offering to your average consumer, and then Quest, which competes in the more premium segment. That's supported through three different facilities, one being our manufacturing facility here in Alberta, and then two cultivation facilities across BC and Saskatchewan. When we look at a few other details, it really starts with our product portfolio. We've focused on what we would coin ready to consume, which is products that are easy, kind of cater to the North American culture of ready and on the go, and allow for a lot of trial within group settings and through friends. That's led us to be top 3 in market share. So as recent as Q1, 6.7%, again, placing us 3rd. And that market share represents true profit behind it, with strong EBITDA, 11 straight quarters, as well as early stages of adjusted net income generation, which just excludes biological asset impacts. So when we get into our highlights, we think we're driving success in Canada in a large way. We've created a strong history of execution and continue to see, a very exciting outlook ahead. With our most recent quarter, we had record level revenue and strong profitability despite seasonal headwinds that everyone seemed to encounter. And that's all supported through this model that we've developed. We're taking that model now internationally, where we believe we've built substantial brand reputation in Canada, and it supports establishing a platform for international growth. So we're targeting new markets in which we can operate in the same effective way, attract customers, and ultimately build brand loyalty in a market that is going through tremendous tailwinds of growth through legalization in a similar fashion to Canada. That started off with an asset-light expansion, starting with Israel in the 4th quarter, and certainly new markets to come during this year. Just a quick snapshot, we're well positioned to go and execute on both Canada and international with cash flow, access to debt capital, an accordion, and a low leverage profile that positions us very well in what is a very challenging market at the moment. And all of that, where we try to get as much of this story out there, we believe that we trade at a significant discount despite our profitability, and certainly the trend and history of execution that we've built. And so certainly encourage everyone to do their own work and look further at the story. When we look at our track record, all of the short-term targets on the left-hand side are things that we've communicated in the past year to year and a half, and we've executed on all of them. So we've seen strong market share growth, stepping into Israel, good revenue, profitability on a number of important metrics, and a strong leverage profile. And as we look towards the future, we see that trend continuing with ample amounts of growth ahead. So within the Canadian market, we believe we can go out and grow our revenue to roughly 200 million. That's over the next few years, in which we see additional distribution coming online. We have a highly concentrated brand portfolio, so introducing new brands that either target different price segments or different types of consumers, and then taking our existing brands into new categories as we see good traction when we introduce new products for brands that already have consumer loyalty. Over time, we equally see that international will become at the forefront of our revenue generation. And so we're positioning adequately for that right now, where we want to be early movers in those markets. So over time, we want to be one of the globally recognized Canadian leaders that in turn supports brand recognition on a global scale, all while doing that in a profitable manner. So we feel very comfortable with the margin opportunities we have ahead of us through investment, that we can maintain our profitability and grow it substantially, and at the same time continue to target a very advantageous position from a leverage perspective that gives us a bunch of flexibility. So getting into our portfolio, as I touched on previously, we really believe that cannabis products are trending towards easy, on-the-go, simple to consume products that consist of pre-rolls, vapes, edibles, beverages, and which you've seen over the past 2 years grow substantially to now where it represents more than 50% of the total market. On the right-hand side, you can see how we've positioned our portfolio. So we've invested heavily in growing our margins, having the capabilities and quality and consistency to deliver on this product set. And that's led to us having #1 positions in both vape and pre-rolls, with some of those other categories soon to be entered by either our existing brands or new brands. That has in turn led to us having strong market share growth, participating in that theme I mentioned, but at the same time, really striving for other areas in which we can compete effectively. So the green line represents Decibel's market share growth over the last 2 years, to which we've more than doubled our market share. And that's placed us in the third position, just behind Village Farms at 6.7%. I'm excited to say that that trend's continued past Q1, with as recent as May results putting us at 7.4%, with a lot of catalysts to come over the remainder of this year. And so why we think it's so important that we have that position in Canada that places us in the top few and continue to entrench ourselves is really a belief that Canada is overlooked, but it's a really critical market to be successful in. We think it's the cornerstone ultimately to growing globally. Not only is it just attractive in its own right, it's the second largest market behind California. It has a great opportunity for growth and certainly outpacing the economy over the next decade or two. But it also has very attractive margins for where we sit today with no regulatory changes. Where it becomes really exciting is its capability for export. So there's very limited jurisdictions to which we can export for new legal markets that are coming online that are going to experience very similar nuances to the Canadian and US market, in which early on, quality is a challenge, and growing it at scale and being able to deliver on that is far more difficult. So having that export capability to build an early mover position early on in new markets as they legalize, and being able to replicate, again, what we've built in Canada with quality, consistency, and a consumer-focused approach, we believe is a recipe for success in terms of creating market share and then benefiting from decades-long growth in this market. And so overall, just to summarize, we believe that Canada is really where you can find a pathway to build global brands over time. So getting into our international expansion, it's very early stage, but the opportunity is certainly endless. We've entered Israel, and that was as recent as Q4. We've had ongoing shipments and good success with our brands there. Certainly see additional opportunity for innovation, new products, and new brands entering that market, but overall see a broader opportunity of targeting the EU and other countries that present, again, long-term growth. Certainly the market isn't 200 billion today, and likely with most projections, it's not going to be anywhere near that for a while, but the opportunity is so substantial compared to the Canadian market. If we can build that early mover advantage with the same Canadian model that we've built today, it's going to provide ample amount of opportunity for double-digit growth through Decibel for a very long period of time. Getting into our financial performance to date, we've had another record year, roughly 80 million of net revenues, 17 million of EBITDA, which was about a 21% EBITDA margin. And on a quarterly basis, we're continuing to see a very strong trend. So as recent as our Q1 results, we're already showing annualized sales of north of 100 million and EBITDA close to 30 million. We're, again, very confident given our market share growth heading into Q2 and our initiatives over the rest of this year that we'll continue this trend of sequential growth with very high double-digit year-over-year performance as well. And then getting into our balance sheet and how we're kind of navigating the current market to date, it's a bit different. So certainly it's a bleak sentiment around. There's limited access to capital. There's very few profitable companies within the landscape, and it's highly fragmented. And so cash flow ultimately is king in this environment. And we're continuing very, very strong financial discipline. we believe that it's going to present two different opportunities. One, whereas companies restructure or ultimately try to protect their balance sheet, they're cutting competitive spend. So whether that's marketing, sales, distribution, ultimately those are things that will be well positioned to go out and spend further on to go and take further market share. Or equally, we could see further CCAAs or cheap assets for sale in which the few are going to have an opportunity to pick through and find other brands or assets that help accelerate their business. So through that, we're focused on two primary things. Operating cash conversion, so that's our ability to convert into cash flow from EBITDA. Last year, we were roughly 50%. We're continuing to target 50%. The remainder is getting reinvested in the growth, our new products, our international expansion, but we believe positions us well to react and be very flexible to an environment where there's an abundance of opportunity. And then equally, we're focusing on leverage. So as of our recent quarter, we were 2x debt to EBITDA on a trailing 12-month basis. Annualized, we were 1.6 times. So that gives us an ample amount of dry powder through additional leverage or through our existing accordion that's undrawn to, again, focus on those areas as they come up, whether it be new markets, new products, competitive spend, or M&A opportunities, albeit we're very focused on organic growth first and not disrupting our existing business, which is why you haven't seen any transactions from us to date. Looking at our debt capital, it's extremely attractive and has been a very strong partnership that we've had in place. 86% of our debt is fixed interest rate, so 4.75%. Very attractive, has insulated us largely from a rising interest rate environment, and still has substantial headway. So it doesn't come due until 2027. We believe we have a very strong partner and have no concerns over refinancing. And we have an existing line of $7.5 million that is on standby and ready to draw at any point for any opportunity where we see a good return on capital. So we think that helps us navigate in terms of capital markets today. We think that market share is the most important factor. That ultimately over time will dictate winners and losers, like any other CPG industry, and allows for creating profitability, expanding margins, reinvestment. And so we look at that as a proxy of who's winning and who's losing. And so within this competitive set, we look at EV market share, which is, a non-traditional metric, but we think is a good indicator of value, at least at face value. And then you have to drill down into the actual financial results, to which you'd find Decibel is one of the few who's actually generating a profit from their market share, at least within the top 10 players within the space, which you can see on the bottom half, where we're the only one who's generating adjusted net income, which again is just normalizing for biological asset impacts, no other adjustments. What I think is most telling is our financial discipline when you look at share capital, which is the third line of the table. We've raised less than a tenth of most of our peers. And so we've found a way to maximize the return that we get for every dollar invested and do it in a very lean manner to still position us as third largest in the industry. So we're very proud of that. We think that this is going to continue to be something to be very fixated on. And profitability is really going to drive the success over the next 2 years as this industry goes through consolidation. Getting into how we see it going over time. So certainly cannabis trades at a very substantial discount to many other industries. And that is probably warranted given limited profitability, limited history of results, and the market being very nascent, and much of the regulatory changes that are taking place. That being said, we see over time as this industry matures and you see profitability, consistency, proper communication and execution against that, all of those things happening, we think over time, creates opportunity for multiple expansion and to either trend in line with many of these other industries or potentially at a premium given cannabis's long-term growth that is likely to outpace the economy on a global scale. We think Decibel is well positioned and at the forefront of that, given our best-in-class margins, the profitability that we've had to date, and the track record that we've built to benefit from that margin expansion. And so we think that is a good opportunity to highlight the story and why we trade at such a substantial discount to what we believe is our intrinsic value, where we're not as fixated on day-to-day movements in our share price, but more so focused on building fundamental value through our business with the expectation that over time, the cannabis sector will revert back to norm or potentially trade at a premium to many of these other groups. So just wrapping it up, we're very strong believers in driving fundamental value and that leading to share price appreciation over time. We've done that through creating a very dominant Canadian position and ultimately a platform that allows for high double-digit growth over the medium to long term through international expansion. We've positioned ourselves with best-in-class margins to benefit from both of those segments of our business growing over time, and believe that there's ample opportunity that is undiscovered as of yet that will continue to add to our business. We have proven execution where we've achieved and certainly are on track with all of our company targets that we've communicated publicly, and that we are going to continue to do so in a very capital light manner where we protect our shareholders and we focus on driving value without raising capital through equity markets. And then again, just reinforcing, we believe that we trade at a substantial discount ultimately to our peers and to our intrinsic value. And so would like to encourage in-market buying and certainly taking a harder look at Decibel.
Great. If you're done there, Stu, thank you very much for the presentation. We really appreciate that. So happy to move into the Q&A session. As a reminder, the audience is welcome to submit questions through the chat, or else you can email me directly. But I'll kick us off here with the first one. So I want to start off by asking you, Stu, about Decibel's history and really pioneering the infused pre-roll market in Canada. Obviously, that's been a huge tailwind to your success and momentum over the past several quarters. How did it come about where you were willing to make such a big investment in a single product category? And do you see the potential to do this going forward in new product formats as they emerge? Is your model and your setup flexible today to be able to capitalize on changing industry trends?
Yeah, so how we really found that opportunity is through very aggressive consumer insights. And we're constantly scouring consumer data, not only through R&D at our own facility, consumer focus groups, as well as looking at other emerging markets, where infused really was starting to come to the forefront within the US. Again, we invest heavily within those products in kind of the early trial period to make sure that they're really hitting the mark for the customer and we're delivering a good value proposition. But we actually are very capital light at the front end of any sort of new product launch. So we try to de-risk it as much as possible. Again, trying to be very lean and disciplined, where everything starts off manual. And that's where you see our margins over the past 4 to 5 quarters certainly expand dramatically, because we start with limited investment in equipment, manual processes, and then we create a list of investment opportunities over time where it's sized appropriately to the scale and demand that we see in market. And so we have much better clarity over return on capital, over managing our costs, and so on. We do believe that there's further opportunity for innovation within this space. It's going to get harder over time, and not everything's going to be as easy as launching our infused pre-rolls, but we'll have another product coming out shortly that we think hits the mark in that regard, and we're continuing to do so. And very much our portfolio development consists of focusing on kind of down the fairway opportunities that we think are low-hanging fruit, cater to customer needs, and then also dedicate a portion of our time and resources towards what we'd consider asymmetrical return products, where they may be a bit fringe or unique or new to the market, but create far more upside if it does end up resonating with customers.
That's very helpful for understanding the strategy. Appreciate that. I want to touch on another thing you brought up in those remarks, which was the ability to look at customer data quickly and do a lot of research on the front end before deciding to invest in a product category. To that point, one of the unique aspects of Decibel is it does have a handful of stores, and it was one of the very few LPs that does own a small retail network. How does that inform your ability to get a sense of what the consumer is doing in a timely manner, and how does that feed into your product innovation?
It was very helpful early on, and I'd say it contributed largely to our success on the product development side. And so you'd always see other retailers saying, "Well, are you guys trying to compete with us? And does it get in the way of our partnerships that we have?" And the response is always no. We're not investing or trying to grow those stores in any way, but what they do in turn is help provide a better experience for retailers, customers, and the rest of our partners. They inform a lot. They allowed us to be very nimble, see consumer trends very early on, and tap a large network of customers to understand what future products they'd want to see. So we had a 25,000 customer email list. We could use that to understand new products that customers want that don't exist today, and then take that into the R&D stage. And equally, it provided a R&D training ground where we could sell in a legal manner and compliant with Health Canada early stage products into those stores, get consumer feedback, and make tweaks to our products so that when we launch them on a national scale, they're far more successful. Now we have an R&D license, and certainly that fills in a lot of that work that otherwise would have taken place on our retail stores. But we still find them very helpful in informing and building a stronger relationship with consumers in general.
That's great. I want to switch gears and maybe talk about the international market opportunity, which you alluded to as part of your growth plans. How does the momentum and your experience in the Canadian market prepare you to compete on an international scope? What do you think is the most important aspect of your strategy for winning overseas?
Yeah, I think the most important aspect is as simple as it may sound, is maintaining a commitment to quality, consistency, and a reasonable price. When you look towards international markets today, pricing is, certainly elevated compared to Canada. And you see people approach the market in different ways, where some may view it as an opportunity to offload less quality product given the level of competition in Canada as of today. We actually view it the opposite. Canada represents 5 billion as of today of total market opportunity, and certainly international is going to represent 10x or more than what Canada is. And so just having the discipline to make sure we're getting good product to that market. We're not trying to take advantage of the pricing that we're seeing today, but we're thinking about the pricing of tomorrow. And we're trying to have the consumer in mind at every given step. I think is really critical early on, because it's been proven if you make the consumer feel like they've been ripped off in any sort of way, or don't deliver on your promises, there's another 10 brands in line behind you to go in and take that consumer and keep them as a long-term customer.
That's great. Maybe a final question would just be on your M&A and the potential to do that in the market. You said over the past few months you haven't been so active there, as you've been heads down focused organically, but you've also alluded to a higher number of opportunities coming to market. What would be the best fit for Decibel when you think about M&A opportunities and the ability to consolidate maybe just struggling or distressed operators, but which do have some parts of the business that are valuable? How do you see that playing out over the next few quarters or over the next few years?
Yeah, we take a longer term view on the value that you can get from M&A and how we see this market unfolding. Ultimately, we think it's still a race to the top. I always like to be a historian in these situations and look towards the alcohol market as a proxy, and what makes the large incumbents insulated from fragmentation and from new entrants coming into the space. And what it boils down to is size and scale that affords the majority of your spend going towards competitive activities like sales, marketing, and distribution. That's really what what economies of scale would represent as being an insulating factor. And so we believe that we need to go through tremendous growth over the next 5 to 10 years to position Decibel as one of those large incumbents, not only in Canada, but in international markets. And we think we have an organic growth strategy that gets us there on our own. Where M&A comes into the fold is accelerating that strategy, or allowing us to do something that otherwise has risk associated with it. And so when we sit here today and we look at an abundance of opportunities that are available and up for sale, we focus on a few key things. Is there a competitive advantage to the business? Is it a distraction from our existing organic growth strategy? And is it going to take away from us being able to execute on it? And so effectively, is it a turnaround, or is it a business where our resources can help scale it faster, quicker, or reinforce it in some manner? And so certainly we want to keep our eyes peeled, look for those opportunities. We do think some exist in the market today, but then it's just a matter of timing and when it's appropriate, and certainly letting other companies go through that period of maturation that we all are going through. So we're not urgent. We're trying to be disciplined and patient, and recognize that much of the M&A that's taken place to date has been value destructive, and so we need to be extremely thoughtful in our approach.
That's wonderful, and thank you very much, Stu, for all your insights on that question and throughout your presentation. Decibel is clearly doing very well in the market, and you've got some great momentum behind you. And thank you for joining our event. So thank you very much. And with that, we are pleased to move on to our final speaker for today, and certainly one of the key highlights of our event. I'm very pleased to welcome Beena Goldenberg, CEO of Organigram. Organigram was one of the first licensed producers of cannabis in Canada, being very early to identify the growth potential in the industry. Since the onset, Organigram has focused on efficient production of high-quality cannabis products, opening its first facility in New Brunswick, where hydro costs are well below average, and utilizing cultivation technology to improve yields per square foot and optimize production process. This has supported Organigram being amongst the first of its early mover peers to achieve positive EBITDA from cannabis operations. Moreover, the company continues to invest heavily in future growth, including a very clear corporate focus on innovation. This is evident in recent announcements, such as the partnership announced with Green Tank and Phylos Bioscience, with the goal of delivering breakthrough product innovation. Organigram has maintained a healthy balance sheet with no debt on the books today and a sizable cash reserve. With that, I'm very pleased to turn the call over to Bina to talk more about Organigram and its unique strategies in the Canadian cannabis market.
Wonderful. So thank you for inviting me to join my esteemed peers that have also spoken on this call. I'll start with who Organigram is. And as you mentioned, we were founded back in 2013. So one of the first licensed producers. We're proud of the fact that last year in the KIND Awards, we won both Licensed Producer of the Year as well as the top innovative product of the year. Our vision is to be a respected global leader in the emerging cannabis movement. And that's really important because we're in it's a new industry, it's emerging, and it needs leaders to help bring it, keep it compliant, keep it ready to go out there and explain how to do things efficiently, how to become good operators, how do you actually make money in this business. Our mission, as you mentioned, is to delight consumers with trusted brands that deliver innovative cannabis products and experiences. So that's all about the focus on innovation. But on top of that, we're promoting education and industry advocacy, which we believe is part of the role of a leader in the industry. Okay, so a little bit about our team. So we have over 1,000 employees across Canada. We operate in 3 different provinces: New Brunswick, Manitoba, and Quebec. And they're all very much passionate about the plant and about bringing great quality products to the market. We have a very diverse workforce. Over 46% is female, and 50% of the leadership team is female. And we have a very experienced and professional management team from a variety of industries, including consumer packaged goods, tobacco, other cannabis companies, pharmaceuticals, and the like. We also give back to the communities in which we operate. We have an employee-led volunteer initiative. And since launching the program, which is called Organigram Operating for Good, our employees have donated over almost 2,000 hours in support of their local communities. Some of Organigram's key strengths that I'll talk about throughout this presentation. And as you mentioned, Andrew, a strong balance sheet. We have a state-of-the-art facilities. We've got strong financial performance, national and international reach. We're focused on innovation, and we bring excellence in execution. And so with that, we talk about really in-depth understanding of our consumers and a track record of successful post-M&A integrations. So let's start with our state-of-the-art facilities. So first of all, in Moncton, we have our indoor cultivation grow facility. It's one of the largest indoor cannabis facilities in the world, with over 100,000 square feet, with a capacity to produce 5 kilos of low-cost, high-quality indoor grown flower. We use a unique 3-tiered operation that we get great consistency, and have 115 growing rooms, so we could replicate the environment and get a lot of results in terms of the cultivation optimization and dial in the environmental conditions much quicker. We also have in our Moncton facility, our Center of Excellence R&D collaboration with British American Tobacco, which I'll talk about soon. In Winnipeg, we have our edibles and derivatives facility. It's a large-scale automation facility And it has helped drive our edibles into the number 2 market share by volume and number 3 by dollars. It's a purpose-built, automated 51,000 square foot facility. We make not only edibles, but we make lozenges. We could do pectin and gelatin, sugar-free and sugar gummies. Highly automated with both production and packaging line. And as of February, we were producing over 3 million gummies per month. When you look at in Quebec, we have our Lac Supérieur. It's a premium quality cannabis, so craft flower production and hash production facility. This business was acquired in December of 2021, and we were able to drive to number 1 market share of hash within 15 months. The craft flower is hand-dried, hand-trimmed, and it's artisanal premium quality, as is our Afghan-style hash. We are in the process of doing an expansion to the facility. We've added 30,000 square feet, which will bring our hash production up from 1 million to 2 million units per year, and our greenhouse from 600 kilos of craft flower up to 2,400 kilos of craft flower. We've also have a newly commissioned ultrasonic blade with a capacity of doing 150 units per minute of our new Shred X Rip Strip hash, which I'll talk about as well. So as others have said, there's a lot of focus today on, being careful with cash, and, it's a tight capital market. But as Organigram has some cash to invest in our business, we have been able to make very smart return on investment capital decisions that allow us to drive our gross margin moving forward into the future. So where our investments have gone have been on automating packaging. We've just received and installed and commissioned a new tube-style pre-roll machine that will help increase our pre-roll capacity and speed. On the processing side, with significant savings by bringing remediation in-house. We have a large-scale drying machine that is driving significant time-saving reduction, and then bringing lab testing in-house. So many investments that will drive ongoing gross margin and a sustainable gross margin going forward. We have a strong portfolio of brands where we meet consumers, whether it's through the value segment, mainstream, premium, or craft. Our brands each have their own very specific lineup of formats that meet that what they're all about, with very tangible attributes. So if you think about Big Bag of Buds, it's going to be a value offering whole flower only option. Where you're talking about Bonjour, it is our CBD and minor cannabinoid gummies that come out in that portfolio. Now we match up our brand portfolio against some proprietary consumer segmentation research, where we went across to really understand the consumers and who they are, how much, what percentage of the population they represent, how much volume they consume, and what is their motivation. And by doing that, we've looked at the first 5 segments, really represents over 85% of the tonnage being sold in Canada today. And you see how our brands line up into each of those segments. I'll specifically highlight the Cheap High Chaser, a very large consumer motivated by the lowest price and the highest THC, but they're very much interested in full flavor. And this is where our Shred brand, with Shred is over a $200 million retail brand today. It really meets that consumer. It is a value offering with very high, bold flavors that meets that consumer demand. And talk a little bit about some of our brand performance. I mentioned earlier, we launched our Rip Strip hash back in the beginning of March. Within the first 2 months, we sold over 60,000 units, which was a retail value of over $1.7 million, and continue to build distribution. So what it is, it's a 2-gram piece of hash that has perforated 10 into 10 strips. and it allows a consumer to rip off a strip and put it by themselves into their own pre-roll to make their own infused pre-roll. Now, our rip strip hash is heavily infused with botanical flavors. So again, tied to that shred consumer that wants bold flavors. So we're making it easier, and it's received great online comments about how exceptional this product is. Our Monjour product that I talked about earlier is the #1 CBD gummy in the market. Our market share doubled in the past year. And we have a unique offering where we put more than one flavor, so 3 flavors in a jar, to give consumers lots of different, when they're buying the 30 count, it's not all of the same flavor. Again, we have within our Monjour brand, not only CBD, but other minor cannabinoids as well. And finally, with our position, with our hash acquisition of the Tremblant hash and our recent launch of other hash innovation, we have become the #1 LP in concentrates with over a 24% share of market in the hash category. We also just launched our ShredX Heavies. These are infused pre-rolls with over 40% THC. It is that the infused pre-rolls are infused with both distillate and diamonds to get that really high potency. We launched them just at the end of May, getting rave reviews and pick up across the country. And then on our tube style pre-rolls, I mentioned we just installed a new tube style pre-roll machine, and we've launched our Holy Smokes, which is a 10-pack familiar format. It is just launching in the market, and we're selling out on our first orders. When we talk about investments and collaborations, I want to start with our BAT investment that was done back in March of 2021. BAT invested $221 million into Organogram for a 20% interest in the company. As part of that investment, we developed a product development collaboration and the Center of Excellence at our Moncton facility. The focus on the work that's being done there is not short term. It's not about what is the next product to launch in the marketplace. It's about long-term research. Many of you have heard, that there isn't enough research out there to justify claims. We have an opportunity to do the kind of research that does the clinical studies and PK studies to really get to the place where we'll be able to find the right data to support the claims that we believe are critical to bring cannabis to where it needs to go next. You mentioned earlier, we invested in Green Tank Technologies. This was really understanding the consumer and vapes today. There's a significant problem with leaks and clogs, and where you get pools of vape that is heated over and over again and drives some unpleasant flavors. What Green Tank has done is invent a meaningful innovation for the vape technology. It's a novel heating element which replaces the ceramic that is in current units today, and it produces a consistent flavor and even a smaller particle size, which will provide even increased potency. We're very excited that we have an 18-month exclusivity on this S1 platform, and we believe by coming into the marketplace with something differentiated, consumers will see the value and really look to this kind of technology moving forward. We also invested recently in Phylos, and this was our first investment in the US. Phylos Bioscience, they have 2 very unique offerings to us that we are very excited about. The first is they have patented high THCV flower, and THCV is a minor cannabinoid that brings a very differentiated experience to consumers. It's more about it has no cognitive impairment. It's energizing, focusing, and is known to be an appetite suppressant. So we're excited about launching products with THCV out in the marketplace. In addition, we have the opportunity to convert some of our cultivation into seed production. So Phylos is known for their converting into F1 seeds, but this would give you more robust and consistent plants, consistent yields, and terpene profiles, uniform size. So it'll take some of the challenges with using living plants and get them into something that is more predictable, more consistent. It will take out the need for cloning, propagation, and pre-veg. So while it won't be our full garden, half of our garden will continue to look at those unique cultivars and bringing new news to our more higher premium brands. We'll use this technology for some of our core value brands to ensure we have consistency and quality at a lower cost. And finally, we do have a 49% ownership in Hyasynth. They're a pioneer in cannabinoid science. They do biosynthesis of cannabinoids that are using patent pending yeast strains. Really known to be a more environmentally friendly way to bring the cannabinoids to market at a fraction of the cost, and to markets that don't want even any kind of percent THC as part of their cannabinoid offering. So pure offering, so looking at CBD and some of the minor cannabinoids. Looking at the international side, we currently ship to markets in Australia and Israel. In the first half of our 2023 year, we shipped $16 million worth of flower into our international markets, which was more than our full year of 2022. We have extended and upped our relationship with CannDoc. In November, we actually brought in a new multi-year agreement to supply up to 20,000 kilos of flour to Israel. And we just last month announced a new agreement to supply the German medical market through Sanity Group. On the financial side, what we're most proud of is we have a very strong balance sheet. We've got close to $100 million as of the end of our last quarter that we reported in cash and negligible debt. So we have the funds and the ability to take advantage of what is a distressed market and see where we go from here. We have established a trend of revenue growth, strong revenue growth in 2022, and our first half of 23 is trending in that right direction. We also have a focus on growing gross margins. And while a lot of people will talk about percent gross margins, we're most proud of dollars. You don't bring percentages to the bank, you bring dollars, and we've seen consistent growing gross margin dollars. And we've had 5 consecutive quarters of positive adjusted EBITDA with strong performance in the first 2 quarters of this fiscal year. So looking forward, what do we see are the catalysts for this category moving forward? Number 1, we see Canada. We all know Canada is still the largest federally legal market. There has been a Health Canada review where submissions were due May 24th, which was really focused on simplifying some red tape and some of the regulations to make operations more efficient. There's also a Cannabis Act review that's undergoing now, and an ICED table on cannabis that is kicking off next week. And we're hoping that these are avenues that will allow us to reform the regulations, especially around consumer education, so we could talk to consumers more about things that aren't just price and potency, but around the quality of the terpenes and the experience that the flowers will deliver. And we're also hoping to get a relook at the onerous excise taxes and regulatory fees that others have talked about. We do anticipate an industry shakeout in the next 12 months, but we are happy to see that there are signs of stabilization of flower pricing, and that will bode well for us moving forward as we continue to drive costs out of our operations. On the US side, everybody's heard about, say, banking, I'm a little bit more interested in the efforts behind rescheduling, as I think it will be a catalyst. But we do see more states going legal every time, and ultimately federal legalization will happen, but timing is hard to predict. And finally, there was a lot of noise earlier this year about Germany, and everybody was pretty excited. Now the pilot, it's changed a little bit, and it's a much smaller pilot operation, but we're starting to see pilot projects in other European countries, and we think that bodes well, and we think we could leverage our expertise in growing and our knowledge of cannabis as we look at expanding into a global leader. And finally, what's next for Organigram? Really ongoing economies of scale and efficiency in cultivation. We plan to continue to build on our brand equity and looking at even licensing our SHRED brand into other markets around the world. We're looking forward to the product development collaboration with BAT, yielding some industry-leading research, which will be able to commercialize and actually make some claims around it. We're expecting to leverage our green tank technology this summer with some new vapes coming into market, and really to continue to explore other international markets. And with that, I will turn it back over to you, Andrew.
Great, thank you, Bina. And as a reminder, the audience can submit Q&A questions either through the Q&A function of the Zoom webinar or directly to my inbox. I'll kick us off here with an opening question. It's really interesting to me to learn about that of all the strategic priorities, Organigram lists innovation first on its MD&A, and clearly that was also evident in the investor presentation you just provided. Why does the company view innovation as so important to a successful strategy? What maybe behaviors or patterns are we seeing from consumers, or what opportunities do you feel are untapped that requires innovation to properly address these opportunities?
Yeah, sure. So first of all, to start off with, we do spend a lot of time talking to consumers and really understanding what are the things that they're looking for and what isn't meeting their expectation. So something like our green tank investment was really about recognizing that today's vapes, and we know that in the market in Canada, it's mostly 510 vapes, just aren't meeting the consumer in terms of the hardware. I'm not talking about the flavors or profiles, but the hardware just is creating consumer complaints, and the recognition that if we really want to succeed, we have to be able to address those consumer needs and find the investment opportunities that are out there that will take us as a differentiated position in the market. It's a highly competitive market today. We know when we launch innovation that others will look at it, and if it's successful, they will copy it. So, you talked earlier to my colleague over at Decibel about infused pre-rolls. Well, everybody, including ourselves, are launching infused pre-rolls. So you have to be able to understand what's out there. You have to be able to move quickly and be out there and take advantage of being an early mover, but also at the same time, get your costs down, because as more competitors are coming in, you have to be able to do it more efficiently and so that you could manage your margins going forward. We're very excited about the work done on our SHRED-X strip hash. This was really an innovation that brings hash to a much greater consumer community. Hash is a very specific product that, some people, swear by, but it is intimidating to new users. And we found a way to bring something and make it simple, easy to use, and very accessible. So it's all about continuing to build that relationship with consumers, with your brands, but also understanding their needs and bringing those products to market.
That's great. And you made a great point there too, that innovation isn't only happening on the product and product development side, but also on the efficiency side. And as new participants enter a market or a product category, you also got to get more efficient at making it. So maybe you could speak to some of the investments Organigram is making or has made to be amongst the most efficient operators, let's say, within the Canadian cannabis industry, or how do you get cost or scale efficiencies in cannabis?
Yeah, so absolutely. So first of all, you have to have a facility that you could control the environment. So you optimize and dial in to get the best yield and the highest potency you can out of the flower. Craft, we're not going to be a craft producer in our Moncton facility. We will do hand trimmed in our Lac Superior facility where we make craft product. But this is a high volume, 85,000 kg per year facility. You have to be able to operate it efficiently, reduce the amount of labor, use more automation in your processing and in your packaging so you could get your costs down, right? One of the greatest costs on cannabis besides excise tax these days is labor costs. So it's all about getting those labor costs down where you can, right? You can't use automation today on plant care. That's still very important, but where you can on packaging and on some of the processing, as we've just done on our drying, there's ways to get costs out, shorten the time. You shorten the time, you get turnover of your rooms faster, you get more throughput. There's a lot of opportunity to drive efficiencies that way.
Great. And then also in your industry outlook, you spoke to the potential for a shakeout over the next 12 months. What is Organigram doing today to make sure it's positioning for that, to make sure you capitalize on opportunities that could emerge in a consolidating industry?
Yeah, so one of the things that I perhaps didn't focus enough on when I went through my presentation is we have a great track record on acquisitions. Where others have done acquisitions and have seen their market share erode, we have done acquisitions first to get into the gummy space and are now the number 3 player or number 2 by volume. And then we did the acquisition of Lac Superior and got into hash and are the number 1 player currently in the hash market. So it's recognizing that as we sit on our cash, that we look at opportunities, but we're not interested in looking at things that are overlapping with our existing portfolio and options, but are really providing unique add-ons that will be complementary, that will drive our overall business growth and extend our portfolio so we meet consumers at every place they're looking for in cannabis. And really that's what it means to be a leader. You need to really understand the total market, not just specialize in one area. And you also need to be out there, in Ottawa, helping drive change in the industry to drive the excise tax down and get everybody much more efficient.
That's great, and appreciate all of your insights today, Beena. We thank you very much for joining us. Excellent presentation there.
Thank you so much, Andrew. It was a pleasure being here.
And with that, that will conclude our presentations for today. I would like to thank everyone for joining this event, and I want to share a special thank you to our presenters today, Raj, Margaret, Stu, and Beena for their involvement with today's event. We heard from many of the most successful companies in the Canadian cannabis industry as to how they have identified and executed on winning strategies in a competitive market. We hope our listeners walk away with an understanding of why these companies have been successful and how they plan to maintain this momentum going forward. It is important that investors understand why certain strategies have worked, since we believe that the companies that developed these winning strategies potentially hold the key to building a winning platform, not just in Canada, but globally across emerging cannabis markets as well. So with that, this concludes today's conference. We will wrap up the event now. Thank you everyone for attending, and I hope you have an excellent rest of your day.